Good day, grade 12s. My name is Carden Madzokere. I'm the author and publisher of the Distinction Bound Student Textbooks, and welcome to Lesson 1.6 under International Trade, otherwise known as Foreign Exchange Market. Topic 4 of Macroeconomics. Right, study the extract below and answer the questions that follow. It says here, South Africa's balance of payments, second quarter 2019. Okay, the balance of payments consists of a current account, capital transfer account, financial account. So those are the three accounts that we find. We used to have reserves as a separate account, but now it seems the Reserve Bank is calculating it within the financial account. I think around about 2015, they changed the way in which they calculated the balance of payment. But one thing is still the same. Gold is still separate. In our current account, it's recorded as a separate, component, separate from merchandise exports, because gold should be merchandise exports. But maybe before I go further, let me define. I know I still have to read this, but yeah. Balance of payment basically is a systematic record of a country's transactions with the rest of the world. So basically, we record all the transactions. Well, let me take you back a bit. So this topic comes under foreign international trade. We start the topic with reasons for international trade. Why countries should trade with one another? Well, where we have demand reasons and we also have supply reasons. After exploring them, we also look at the effects of international trade, things like specialization and appreciation, depreciation of a currency, and so forth. Now, beyond that, since we trade with one another, there is, this thing called the balance of payments. So here, we systematically record our transactions with the rest of the world. So the things that we bought from them is recorded on this. So at the end of the day, the theory is it has to balance. When it doesn't balance, we call it a disequilibrium. And that must be corrected. So that means we can have a surplus or we can have a deficit. And a surplus is one that's favorable. And basically, it would increase our reserves. All right, so moving on. South Africa's trade balance. Okay. So trade balance is another concept that was not initially before the Reserve Bank changed how they calculate this thing. They didn't have this, it would say memo item. They didn't have it on the current account. But now they'll show the trade balance, which is basically our exports minus our imports. So for us, the formula will be different from everyone else, because everyone else would just say merchandise exports minus merchandise imports. But because our gold is separate, so for us, it has to now be merchandise exports plus net gold exports minus merchandise imports. Then it gives us this trade balance. Okay, so a trade balance can either be a surplus or a deficit. So basically, that's what they're talking about here. So South Africa's trade balance switched from a surplus of 41.9 billion rands in the first quarter of 2019 to a deficit of 27.2 billion in the second quarter. The deterioration in the trade balance came about as the value of merchandise imports increased substantially. Okay, now why could we have increased our imports? Well, many factors could have led to this. Now, this has impacted the terms of trade. Okay, terms of trade is a concept we dealt with in the previous video. Okay, based on how I'm recording this. I skipped some because I have done them in the past. So I'm just looking for videos I haven't done. So I think it was 1.2. Okay. So terms of trade is basically the ratio of export prices to import prices. Okay, so now this was released again by the South African Reserve Bank from their statistical press release in September 2019. Let's go to the questions. Identify the account in the balance of payments. So it has to be one of these three. current account, capital transfer account, or financial account. Let's see. Identify the account in the balance of payment that records exports and imports of goods. Well, that's current account. But some learners will be like, which one is it? Well, the one that says merchandise exports, merchandise imports. Just that you don't see the word merchandise here. Okay, but that's it. Is the current account. Other things that we find in the current account, it's so we have merchandise imports, merchandise exports, we have net gold exports, we have service receipts, service payments, income receipts, income payments. Then we have this trade balance. Okay. Also, we have current transfers. Don't confuse it for the capital transfer account. This is a separate account. And I'm talking about current transfers, which basically is, our gifts, our donations, they will be recorded there, but under the current account. Okay. Now, which commodity is recorded as a separate export item? Well, that's gold. And don't say net gold exports. You are not asked that. Which commodity is gold? Okay, the next one, briefly describe the terms of trade. I did, as I was reading this word here. Well, it's the ratio of export prices to import prices. Explain the impact of an increase in export prices on South Africa's trade balance. Well, two things can happen. If our export prices increase, two things can happen. Number one, it could, because if it costs more for them, it probably means we'll get more money from our exports, and then that would, change our deficit into a surplus. Or it could do the opposite, which is, our exports become expensive, then they would buy less of our exports. Then we'll export less. That could lead into a deficit on our current account. So basically, it depends. It probably depends on the nature of the goods that we export. If they are so important to the foreign market, then they'll still buy them regardless of the price, but maybe in moderation, which might then make us make more money with our exports. Or the opposite, if there are other alternatives elsewhere, then they might buy less of our goods. And but if it's basically the influenced by the world prices of whatever it is that we export, then other countries may not have much option, but they still need to buy those goods. So it's not because of South Africa, it's just because generally the price of gold, for instance, has gone up. So it's not South African gold, it's just gold in general. So that could be this or that. So Then the last one, how can import control be used to correct the balance of payment deficits? Well, to control imports, we could use tariffs. We could use tariffs. We could use direct control, like a complete ban on the importation of certain things. We can use quotas, which is a limit on the number of goods that can be brought into the country. We could use exchange control, which is a limit on the amount of foreign currency that, let's say, a South African resident can be able to purchase on the foreign exchange market. So if they restrict the amount of foreign currency that you can buy, then that sort of controls your imports. So all that can be done. Okay, let's look at our answers. Well, identify the account. Well, we say it is the current account. Which commodity? Yes, we said gold. And then I define, terms of trade expresses a country's ratio of export prices in terms of its import prices. Then number 4, explain the impact of an increase in export prices. Well, it's the one I was saying two things could happen. Let's see here. Export earnings or the value of total exports would increase. Okay, look here. If export earnings increase, it would result in an increase in the value of the trade balance. Okay. So basically, it could cause our trade balance to go into a surplus, or increase the surplus if it was already there, or demand for exports would decrease. You see, this is the opposite, because here, export earnings, the value of exports would increase. Well, basically because the prices of our exports have gone up. So it would lead to the increase on the value, like the rand value of our exports. But it could also decrease the amount of exports, as in because others would see our goods as expensive, so they would buy less. So this would actually reduce the volume of exports and also the trade balance. So if the trade balance decreases, in a way, it could then become a deficit. Or if it's a surplus, it could reduce that surplus. If it's a deficit, it would increase that deficit. Now, the last one, well, how can import control? Well, we said, okay, maybe something different from what I said. Here it says BOP deficit can be corrected by imposing import tariffs. I said it. And then also quotas. Well, import tariffs they're explaining what they would do. And then import quotas, okay. But they did not talk about other things that I mentioned. Now, I also mentioned direct control. Direct control, which is, let me say physical control. And I also mentioned exchange control, which is a limit on the amount of foreign currency that a person can actually purchase on the foreign exchange market. So if you limit that, then in other words, you are making it impossible for me to import as much as I wanted to import. So basically that would control imports. So don't talk about anything that is export related, because the question here is specific. So if you talk about something related to import substitution, would you be wrong? Something like what? Something like subsidizing the production of local goods. I think in a way it would also be acceptable. Yeah, here you see it says accept any other relevant response. So if a learner's mind navigates towards that, I don't think they'll be wrong, because I think they would be correct if they go that route, because our subject is so beautiful. It's not always what comes to your mind. What could come into someone's mind could also make sense. And we should be able to accept those answers, those responses. Well, this has brought us to the end of this particular lesson. And as usual, like, subscribe, and I'll see you in the next one. God bless.